On January 26, 2026, gold prices crossed $5,000 per ounce for the first time in human history. That same day, the dollar's share of global reserve holdings hit its lowest level in 20 years at 56.32%. And while financial media called it a coincidence, central bankers around the world knew exactly what was happening. The foundation of American financial power just cracked wide open. For 80 years, the United States dollar has been the undisputed king of global finance. Every barrel of oil, every international trade deal, every central bank reserve has flowed through dollar-denominated systems. It wasn't just the dominant currency. It was the only currency that mattered for serious international business. But something fundamental shifted in the past 18 months that most Americans still haven't noticed. The monopoly is ending. Not through collapse, not through hyperinflation, but through something far more dangerous: coordinated replacement. Let me show you what's actually happening beneath the surface of mainstream financial news. Because what started as whispers in 2022 has become a roar in 2026, and the implications are going to reshape everything you think you know about money, investing, and American economic power. Here's the data point that should terrify anyone holding significant dollar-denominated assets. In the year 2000, the US dollar accounted for roughly 70% of global foreign exchange reserves. By the third quarter of 2025, that figure had fallen to 56.92%. That's a decline of over 13 percentage points. Now, you might think that sounds gradual. Slow erosion over 25 years doesn't seem catastrophic. But here's what that number doesn't tell you. The pace of decline is accelerating exponentially. From 2017 to early 2025, the dollar lost nearly 7 percentage points. That's half the total decline happening in just 8 years. The curve isn't linear, it's exponential. And exponential curves have a nasty habit of looking stable right up until the moment they go vertical. What changed? Why is the decline suddenly accelerating after decades of dollar dominance? February 2022 answered that question definitively. When Russia invaded Ukraine, Western nations led by the United States froze over $300 billion of Russian central bank reserves, money that Russia had accumulated over decades, stored in what they thought were secure Western financial institutions, vanished overnight. Not seized through legal process, not confiscated after a trial, just frozen, made inaccessible with the stroke of a pen. Every finance minister, every central banker, every treasury official in countries from China to Saudi Arabia to India watched that happen and thought the exact same thing. We're vulnerable. Our national savings could be deleted if we cross the wrong line. And if it happened to Russia, a nuclear-armed G20 economy, it could happen to anyone. The weaponization of the dollar stopped being theoretical and became a demonstrated reality. And that single event accelerated de-dollarization efforts that had been simmering for years. Fast forward to October 31st, 2025. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with new members including Saudi Arabia, UAE, Egypt, and Iran, launched something called the Unit. Not a proposal, not a pilot program. An actual functioning alternative currency system for cross-border trade settlements. The design is strategically brilliant. 40% of the unit's value is backed by physical gold held in verified vaults across BRICS nations, real metal that can be audited. The remaining 60% is backed by a weighted basket of BRICS national currencies. This structure gives them credibility through gold while betting on their combined economic growth through the currency basket. And it's already working at scale. Russia and China now settle approximately 90% of their bilateral trade in rubles and yuan. $0 involved. That's hundreds of billions in annual trade flowing through non-dollar channels. They didn't wait for permission. They built the infrastructure and started using it. Think about what that represents. The two largest energy exporter and the world's manufacturing hub are conducting nearly all their business without touching the dollar. That's not a test. That's a fully operational alternative system. But the real game changer isn't just BRICS nations using the unit among themselves. It's the gravitational pull it creates for third-party countries. Nations that aren't officially part of BRICS, but are watching very carefully. Indonesia, Nigeria, Turkey, Bangladesh, Pakistan, Vietnam. These are major economies with billions of people and trillions in economic output. Many of them are trapped in dollar-denominated debt while their local currencies depreciate. They're caught between geopolitical pressures from Washington and Beijing, and they're all asking the same question. Do we really want all our eggs in the dollar basket when we just watch that basket get weaponized? The unit gives them options, the ability to diversify currency risk, a way to trade with major partners without complete dollar exposure, a potential escape route if they face sanctions or financial pressure. That optionality is the real threat to dollar dominance, because once the alternative exists and proves functional, the decision calculus changes for every country on Earth. Staying 100% dollar dependent stops being prudent risk management and starts looking like strategic vulnerability. Now the petrodollar system, that's the arrangement where oil sales were exclusively denominated in dollars, officially ended in June 2024 when Saudi Arabia chose not to renew its agreement with the United States. That 50-year arrangement died quietly while most Americans were focused on domestic politics. Saudi Arabia now accepts yuan for oil sales to China. The UAE settles LNG exports in yuan. Russia sells energy to India in rupees. The foundation that created automatic global demand for dollars, the fact that everyone needed them to buy energy, is dissolving in real time. And this is where the math becomes unavoidable. When you control 70% of global reserves, losing a single percentage point is a rounding error. When you're down to 56%, every tick lower becomes a structural threat. And the velocity matters more than the absolute number. The dollar's share of global foreign exchange reserves dropped from 65.3% in 2016 to 59.3% by the third quarter of 2024. That's 6 percentage points in 8 years. But here's what should terrify anyone paying attention. The decline is accelerating. The dollar fell to 56.32% by the second quarter of 2025. That's a 3 percentage point drop in less than a year. The trend line isn't just pointing down, it's curving down faster. Central banks are voting with their wallets, and they're voting against the dollar at an increasing rate. Where's that money going? Gold and alternative currencies, but mostly gold. On January 26, 2026, gold prices crossed $5,000 per ounce for the first time in human history. Not $4,000, not $4,500, $5,000. A level that would have seemed insane just 2 years ago. The daily move was nearly 2%, which in gold markets is violent. That's not normal price discovery. That's panic buying dressed up as institutional reallocation. Central banks purchased over 1,000 tons of gold in 2023 alone, the highest annual level in modern recorded history. And 2024 and 2025 weren't any different. China, Russia, and Turkey led the buying spree. These aren't small players accumulating a hedge. These are major economies systematically converting dollar reserves into metal. The share of gold in emerging market foreign exchange reserves has doubled from 4% a decade ago to 9% today. Developed markets hold 20%. That gap is closing fast. Every central banker on Earth watched Russia get its dollar reserves frozen and thought the same thing. Physical gold can't be sanctioned. It can't be frozen. It can't be deleted with a keystroke. It just sits there, immune to political pressure. This creates a reinforcing cycle. More countries buy gold to back alternative currency systems. Higher gold prices make dollar-denominated assets less attractive in comparison. More selling pressure on treasuries. More countries look for alternatives. More gold buying. The loop accelerates, but it's not just about what central banks are buying. It's about the infrastructure they're building to move money without dollars. China's cross-border interbank payment system, known as CIPS, now connects nearly 5,000 banking institutions globally. That's not a trial. That's a fully operational alternative to SWIFT, the messaging system that underpins dollar-based transactions. And it's growing fast. Standard Bank in South Africa became the first on the continent to link directly into CIPS. African businesses can now settle payments with China in renminbi without converting through dollars first. No intermediary, no dollar exposure, no vulnerability to US policy decisions. Then there's mBridge, a system enabling instant payments between central banks in China, Hong Kong, Thailand, and the United Arab Emirates using digital national currencies. No correspondent banks, no settlement delays, no dollars anywhere in the chain. Russia, China, and India are targeting full interoperability of their central bank digital currencies by 2027. The digital ruble, digital yuan, and digital rupee will connect seamlessly. Trillions in potential trade volume flowing through channels that don't touch the dollar system at all. By mid-2026, nearly 3/4 of G20 nations will have tokenized cross-border payment systems operational or in advanced testing. Money converted to digital tokens moving across borders in seconds instead of days. And the fastest movers aren't in North America or Europe. China and India are already live. Brazil, Russia, and Australia are right behind them. This is the technological foundation being laid beneath the surface while everyone argues about whether de-dollarization is real. The plumbing is being rebuilt. New pipes, new infrastructure, systems designed from the ground up to function without dollars. Does this mean the dollar disappears next month? No. The dollar still dominates 88% of foreign exchange trading volumes. It's still the primary invoicing currency for global trade. US Treasury markets remain the deepest and most liquid in the world at over $22 trillion. But dominance and monopoly are different things. The dollar is transitioning from monopoly to dominance. And dominance can erode much faster than people expect once the momentum shifts. Here's the part that gets overlooked in most analysis. The dollar's strength was never just about economics. It was about lacking alternatives. For decades, if you wanted deep liquid markets, reliable rule of law, and a currency that wouldn't collapse overnight, you bought dollars and treasuries. There was no other option at scale. That's changing. Not because the dollar suddenly became weak, but because alternatives that didn't exist before now do. And they're functional. They're operational. They're being used for actual transactions worth hundreds of billions. The psychological shift matters as much as the economic one. Once decision makers at central banks and sovereign wealth funds internalize that viable alternatives exist, the calculus changes permanently. Keeping 70% of reserves in dollars stops being prudent diversification and starts looking like concentrated risk. And there's another force accelerating this that nobody wants to talk about openly. Trust erosion. The United States currently has over 900 active sanctions designations against countries and entities. That number was 120 in 2001. The sanctions toolkit went from a rarely used diplomatic weapon to a primary instrument of foreign policy, and every country watching is doing the same math. If we have a policy disagreement with Washington, if we maintain trade relationships with someone they've sanctioned, could we be next? That fear drives behavior. It drives infrastructure development. It drives the unit. It drives CIPS and mBridge and digital currency interoperability. Fear is a powerful motivator for building alternatives. Russia's dollar reserves dropped from $383 billion in January 2022 to 130 billion by late 2023. That's 253 billion in frozen or sold dollar assets. China's treasury holdings dropped from 40% of their foreign exchange reserves a decade ago to less than 1% by 2025. These aren't marginal adjustments. These are structural portfolio reallocations happening at the sovereign level. So what does this actually mean for you? How does this abstract geopolitical chess game translate into concrete effects on your investments and purchasing power? Start with the dollar itself. Morgan Stanley estimates the dollar could lose another 10% by the end of 2026. The dollar index already fell 11% in the first half of 2025, its worst performance since 1973. That ended a structural bull cycle that lasted from 2010 to 2024. Against the euro, down 11%. Against the yen, down 4%. Against the yuan, down 2%. And this isn't temporary volatility. This is the beginning of sustained directional pressure as the structural underpinnings of dollar demand weaken. A weaker dollar has immediate real-world consequences. Imported goods cost more. Electronics, clothing, vehicles, anything manufactured overseas gets more expensive. Your purchasing power declines even if your salary stays the same. For retirees living on fixed incomes, this is devastating. The dollars you saved 10 years ago buy significantly less today and will buy even less tomorrow. But there's a deeper second-order effect that matters more. Foreigners currently own over 30 trillion in US assets. European investors alone hold 8 trillion in US bonds and stocks. More than half of those European holdings aren't hedged against currency risk. As the dollar weakens, those foreign investors are losing money in two ways. Their US assets might hold steady in dollar terms, but when converted back to euros or yen or yuan, the value drops. And they're starting to notice. JP Morgan reports that foreign investors are adding currency hedges at an accelerating rate. Adding hedges means selling dollars, more selling pressure. The feedback loop accelerates. Now layer in what's happening with gold. On January 26, 2026, gold broke through $5,000 per ounce for the first time in history, a 1.41% to 1.95% daily surge. Central banks purchased over 1,000 tons of gold in 2023 alone, the highest annual level ever recorded. China, Russia, and Turkey lead the buying. Emerging market central banks have doubled their gold reserve allocation from 4% a decade ago to 9% today. This isn't speculation. This is deliberate strategic repositioning away from fiat currency reserves and toward hard assets. When central banks act in unison like this, they're telling you something. They're voting with billions of dollars that traditional reserve currencies are no longer reliable stores of value. The petrodollar collapse accelerates this. Saudi Arabia ended the exclusive dollar arrangement for oil sales in June 2024. That 50-year agreement signed in 1974 guaranteed oil transactions happened in dollars. That guarantee is gone. China now settles LNG imports from the UAE and oil from Saudi Arabia in yuan. Russia, Iran, and Gulf states have long-term oil contracts with China priced in yuan. The structural demand for dollars that came from every country needing dollars to buy energy is evaporating. You need to understand what this means for your portfolio positioning. The traditional 60-40 stock and bond allocation that worked for decades is built on assumptions that no longer hold. It assumes bonds provide safety when stocks fall. It assumes the dollar maintains stable purchasing power. It assumes US Treasuries remain the unquestioned safe haven. All three assumptions are being challenged simultaneously. What actually protects wealth in this environment? Diversification takes on a completely different meaning. It's not just diversifying across asset classes within the dollar system. It's diversifying across monetary systems. Physical gold and silver become portfolio insurance against currency debasement and reserve currency transition. Not speculation, insurance, energy, and commodity exposure through companies with hard assets and pricing power. Technology leaders with global revenue streams not dependent on any single currency. These companies collect euros, yuan, rupees, and yen. Currency diversification is built into their business model. Avoid what breaks first. Regional banks sitting on underwater bond portfolios. Companies with massive dollar-denominated debt and revenues in weakening currencies. Emerging market borrowers who took cheap dollar loans that are becoming expensive to service. Long-duration bonds that get crushed if inflation resurges or foreign buyers disappear. The timeline matters. This isn't a sudden collapse scenario where the dollar loses half its value in a month. That's not how reserve currency transitions work historically. The British pound took decades to lose its reserve status after World War II. But the direction is clear and the momentum is building. Each country that joins BRICS payment systems, each trade deal settled in local currencies, each central bank that diversifies away from treasuries adds to the cumulative pressure. India hosts the BRICS summit in August or September 2026. Expect new announcements on payment system expansion, additional countries joining, progress reports on the unit. These aren't just diplomatic gatherings anymore. They're coordination meetings for building parallel financial architecture. And the pace is accelerating because the incentive structure changed. Every new sanctions designation by the US Treasury, every frozen asset, every financial weapon deployed creates more countries seeking alternatives. The adults in the room see this. Ken Griffin at Citadel warned that bonds lose what makes them special when they move together with stocks. Ray Dalio has been vocal about the need to diversify beyond dollar assets. Jamie Dimon at JP Morgan acknowledges the structural shift happening in reserve currency composition. These aren't fringe voices. These are the people managing trillions who see the architecture changing beneath the surface. The era of the dollar having zero competition ended in January 2026, when the unit went operational. What comes next is the slow, grinding process of alternatives gaining adoption, dollar demand declining at the margin, and the exorbitant privilege eroding 1 basis point at a time. Position accordingly, because the world your retirement was planned for is becoming the world your retirement will struggle in. The question isn't whether de-dollarization is happening. The data answers that definitively. The question is how fast the transition accelerates from here, and whether you're positioned for a world where dollar dominance is a memory rather than a reality. Gold at $5,000 isn't the end of the story. It's the opening chapter. Central banks holding less than 57% of reserves in dollars isn't the floor. It's a warning sign of how much further this can go. The infrastructure is built. The alternatives are operational. The momentum has shifted from theoretical to structural. And once that shift reaches critical mass, reversing it becomes mathematically impossible. The 12-month clock started ticking the moment the unit processed its first transaction. What you do in the next year determines whether you preserve wealth through this transition, or watch it evaporate in a system that no longer functions the way it did for your entire life. The rules changed. The only question is whether you're still playing by the old ones.